judge suggested she may serve her term under an electronic bracelet. Meanwhile, Israeli Prime Minister Benjamin Netanyahu's office says it sent a counteroffer to mediators after reports Hamas had agreed to a proposal for a new truce. Israeli media say Hamas agreed to release 5 living hostages in exchange for a 50-day ceasefire. Meanwhile, Israel has started ground operations in southern Gaza while continuing airstrikes throughout the Strip. And in sports, the Yankees are off to a blistering start to the season after sweeping Milwaukee over the weekend. The Bronx Bombers lived up to their nickname, exploding for a franchise record-setting 9-home run game on Saturday, including 3 from captain Aaron Judge. Their 36 runs through their first 3 games are the most in Yankee history. That's your Bloomberg Brief. John?
Yahara, thank you. Mike, do you want to settle this? Are they cheating or not? What's going on?
It's not cheating. They're doing what they should be doing. They're finding better ways to hit more home runs. But we'll see how the baseball purists feel about that.
And Aaron Judge is also not even using this torpedo bat that everyone says they're cheating with. And people used it last season, and it's MLB approved. I just think haters want to hate when it comes to the Yankees, and they're finding any reason to do it.
Case closed, apparently, on Bloomberg Surveillance. Up next on the program, counting down to Liberation Day.
The tariffs will be far more generous than those countries were to us, meaning they will be kinder than those countries were to the United States of America. You'd start with all countries, so let's see what happens.
You'll see what happens in 2 days' time. Henrietta Trays of Veda Partners joins us next, and we'll have more with Mike Wilson of Morgan Stanley. From New York City this morning, good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
What a month it's been for downgrades. We've had downgrades from HSBC, from Citi, price target cuts from Ed Yardeni, from RBC, from Barclays, from Goldman Sachs twice in the last month or so. Equities down again this morning by 1% on the S&P. We're negative by 1.4% on the Nasdaq. The loss is much worse this morning over in Europe. The equity benchmark in Frankfurt, Germany, the DAX this morning is down by close to 2%. Under surveillance this morning, we're counting down to Liberation Day.
The tariffs will be far more generous than those countries were to us, meaning they will be kinder than those countries were to the United States of America. You'd start with all countries, so let's see what happens. There are many countries. I haven't heard a rumor about 15 countries, 10 or 15.
So you're starting with all countries?
countries that we're talking about. We wouldn't be talking about all countries. That's not a cutoff.
So here's the latest this morning. President Donald Trump planning to start his reciprocal tariff push on all countries, tempering hopes that the initial scope could be limited on Wednesday. Henrietta Trace of Vader Partners joins us right now for more. Henrietta, let's start with the $1 trillion question. What happens on April 2nd?
April 2nd at midnight, lots of tariffs start going on. So it's going to be a really long day. We'll obviously get the reports from USTR, Commerce, and Treasury on the 1st. I think there's going to be a lot of advance warning provided by those documents. You know, we have trade agreements with 20 different countries. And I think when the president says we're going to tariff everybody that we're talking about, he means those 20 countries. So I'm expecting to pull out of the phase 1 China deal or call them out in violation of the deal, which means that all the Section 301 tariffs covering over $350 billion worth of goods from China will go up. I think we're going to see new tariff investigations start on India, for example, pharmaceuticals. I think there's going to be new tariffs under Section 232 and IEEPA across the auto sector. I'm very wary about auto parts. I think that'll be sort of a secondary event that happens in a couple months' time should any of the nations like the EU not come to the negotiating table sufficiently. It takes a long time to get through. There's a lot coming.
Henrietta, what do we see that can happen almost immediately when it comes to IEEPA or 338? Is that going to specific countries or is that going to industries?
IEEPA is specific countries and industries, although Section 232, the national security justification, is really where a lot of the sector-specific items go. Lumber, copper, dairy, things along those lines would be a Section 232 tariff. My biggest concern with any rationale that's not IEEPA or even 338 is that there's no time horizon to take them off. The Section 232 tariffs on steel and aluminum have been in effect for almost 8 years. The Section 301 tariffs against China have been in effect for almost 8 years. So once those tariffs come on with a rationale, like the auto investigation that they completed during Trump's first term, those tariffs don't come off. So those are the most pernicious. The IEEPA pieces on Canada and Mexico, for example, theoretically can come off in 3 to 6 months. The others have very serious staying power.
Henrietta, when it comes to how the president is approaching Wednesday, he said we're going to start with all countries. Is that where he's going to end?
That's a fair question. I think we start with about the 20 countries that we have trade agreements with. That's what the agencies have been tasked with doing. But I see the potential for expansion before we see any pullback. So, for example, there's no investigation into India. I mentioned that at the outset. I think we have a lot of issues with India, from trade in pharmaceuticals, generic drugs, the trade in services deficit. Those are all sort of institutional issues that we know USTR Greer had during Trump's first term. And I would expect to see a really long drag to any approach to India. So I think a lot more are going to come on in the next 4 years of Trump's term than necessarily come off. Although Canada and Mexico should be excluded, especially USMCA compliant pieces. That trade deal needs to be re-agreed to by next summer.
When it comes to what the Senate is also going to do tomorrow, there's supposed to be a vote on a Democratic resolution blocking Trump's use of IEEPA when it comes to Canada. How difficult is that going to be for some Republicans, whether or not they're going to say yay or nay?
Well, just think about it. There's already reporting that we're going to see a bailout for the farmers, which is widely represented by Republican lawmakers in the United States Senate, including the Majority Leader, John Thune. I think it's fascinating to see tariffs go on our closest trading partners, and Republicans, who just were a couple years ago were the party of free trade and 0% tariffs, now have to get behind the president's justification for fentanyl from Canada being an international economic emergency. So you're going to see some serious backpedaling, which is compounded by the election losses that Republicans are seeing across the country. Obviously, with the Elise Stefanik seat in upstate New York, but just this past weekend on 4 amendments in the deep red state of Louisiana, where Democratic voters turned out after being sleepy for 6 years and crushed 4 amendments. We're going to see that in Florida in 2 different districts, the 1st and the 6th, to see what the margins look like. Is it still Trump plus 30, plus 40? Or is it now something that Republicans should be more concerned about going into the midterm? It's a very big vote tomorrow.
How much pressure are Republicans under to make sure they get TCJA extension done sooner rather than later?
Tons of pressure. It has to be done. I think the best triggering mechanism is the X date for Treasury. So we know that we've gotten estimates from outside advisors and CBO that suggest late July to even mid-October is the time horizon. But all the staff on the Hill, which I used to be one, are making sure that we're hearing from Treasury Secretary Bessent. And he's not going to report that date until May. And it really is going to depend on tax receipts. So it's disconcerting when you see DOGE going in and firing IRS employees. It expands the tax gap. And that's really what's going to determine what the X date is. And that's, I think, the linking mechanism for passing this tax bill, which, as you pointed out before, is just an extension of the status quo. There are not and there will not be tax cuts in this bill.
2 days to go, Anne-Marie. And even after that, we've got so much more to get through before we get to the end of 25.
Right, because many are thinking that this is Trump coming in, a maximalist approach, and he wants to do deals and negotiations, which means we could be talking about trade and the uncertainty of trade for the next weeks and months of this year.
Henry Trace there, Vader Partners. Mike Wilson of Morgan Stanley still with us around the table. Mike, Trump put versus Fed put. Who blinks first and why?
Well, I mean, I've taken the view that it's probably the Fed because growth is deteriorating further here. Now, in other words, I think that the concern around tariffs on what that's doing to inflation is it kind of gave the Fed an excuse to take a break. Let's not forget the Fed cut 100 basis points last fall, really in the absence of any labor issues. So the question is, we're digesting that. Also, the back end of the bond market rates went up during that period. So I think the tariffs provide a nice excuse for the Fed to take a pause here. But I have no doubt that if we saw a major deterioration in the labor market, the Fed would act. And I don't think the president is in a hurry to blink because, as we were discussing kind of off camera, I mean, they have to do things quickly here. And they've said that, like, we gotta do as much as we can the first 6 months for a couple of reasons. A, we don't want to get dragged back into the quicksand, okay, of, the policy making. And secondarily, the midterms come up in 2 years. Your last guest was just talking about some of the political ramifications. I think that's not a concern now, but it probably becomes more of a concern later this year.
But when it looks at the political ramifications, you are seeing it come up, not just consumer sentiment, but also polls. People are still concerned about the cost of goods now, and they're concerned about tariffs adding to that. What is going to regulate Trump if it's not the politics?
I think, look, he's really trying to follow his agenda. He's trying to check the boxes on the things that he promised he would do for the American people, and a lot of those things are market unfriendly. I mean, that's what we're really discussing here. Is he worried about the market, or is he worried about his agenda and doing those things? I think he's more worried about his agenda. And that was a big adjustment period. I think in January, February, we were talking about this, that I think people were a little complacent in this idea that he was going to be so markets focused. And to me, that's really when the stock market in the U.S. started to have problems, is when first the Treasury Secretary said it, and then the president basically supported that view. And that's the big adjustment thing for the markets, okay? Not the economy, not jobs, not confidence, but the markets. And the problem is we're such a financialized economy now that the markets are the economy. And that's really weighing on consumer sentiment.
Mike, credit to you. I remember that morning, very early on this year, and you came in and you said he's not talking about the market. He's not talking about the market, and he's continued to ignore the stock market. The focus that we've heard is Main Street over Wall Street, and that is a shift in the second term relative to the first term.
That's the term I was going to use, Main Street over Wall Street, because it's the term the Treasury Secretary has used time and time again. He sat in a room at the Economic Club of New York just a few weeks ago and said, Wall Street has done very well. I was one of you. Our focus is squarely on mainstream and making sure everyday Americans are doing better, which means bringing jobs back to the U.S. heartland.
Yeah, I want to add something here. I think that people weren't aware of. So in Trump's first term, we had massive slack in the economy. We were coming off a period of secular stagnation. So, reflationary policy, right, which is what Trump came in with the first time, made a lot of sense. And we were very bullish on that at the time. This time around, we came in with no slack. We have a negative output gap. Okay, so it's just a very different setup. Even if they wanted to be pro-growth, they really can't, which is why I think they're focused on the bond market, back-end yields, as opposed to the stock market. And to me, that fits neatly with the setup that we had that had nothing to do with the election. That's just a setup that we're in.
Mike, a clinic as always. Good to catch up. Appreciate it. Mike Wilson there of Morgan Stanley. Up next on the program, Vikram Malhotra of Mizuho on record demand for data centers from New York with equities down. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
This has been a long first quarter. The final month, the final day of the first quarter. We're down so far in the month of March by something like 6% on the S&P 500 and heading towards the biggest monthly loss since 2022. Down another 1% this morning on equity futures. On the Nasdaq, we're down by 1.6. With 2 hours until the cash open, here are your morning movers with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Robinhood here, falling 6.8% as we're seeing a broader sell-off among crypto-linked stocks. That's because Bitcoin prices are falling, and of course, there's just this overall risk-off mood in the market. And as we know, Robinhood, of course, does get a big chunk of its revenue from those cryptocurrency trades. Next up, we're seeing shares of Mr. Cooper soaring here in the pre-market, up 25% after it was just announced that Rocket Companies will acquire Mr. Cooper in an all-stock transaction for $9.4 billion. The company saying in a press release that the combined firm will service more than $2.1 trillion in loan volume. The deal is expected to close in the fourth quarter of 2025, so some M&A action there. And last up, a check on Tesla. Those shares are down 6%, leading the Mag 7 lower. And this is after Musk opened up about how his role on Trump's Doge team is impacting Tesla. He spoke at a rally in Wisconsin and said that the Doge job is costing him a lot and pointed to the shares plunging. Also, just in the last hour, we got word from Stifel. They are cutting their price target on Tesla from $474 to $455. John?
Hara, thank you. That stock is down again. Tricky moment for that name and its leadership at the moment. Equity futures down by 1 full percentage point. If you are just joining us, bond yields down across the board. We're now down 7 at the front end of the curve. The 2-year at 384. 10's down 6 to about 420. On our radar this morning, President Trump threatening tariffs on all countries. On Liberation Day this Wednesday, Trump responding to reports only 10 to 15 countries would be targeted.
So basically he's saying that's not true. We're starting with, and I think that starting with is a key point of what the president said yesterday on Air Force One going from Mar-a-Lago back to Washington, D.C. We're starting with all countries, which makes me think Trump is going to come in with a very maximalist, aggressive tone when it comes to tariffs, and then potentially you'll have weeks or months of either reports and investigations underway when it comes to trading partners and potentially negotiations.
This is the decision that investors have got in front of them right now. It's the judgment call. Do you think this is the beginning of further negotiations or a clearing event? We heard from Mike Wilson and Morgan Stanley, who thinks this is just the continuation of further negotiations. It's the starting gun for more of the same on Wednesday.
I think it's very hard to say if this president likes to use uncertainty in all forms of policy. Why would you think that Wednesday would be a clearing event? I would note tomorrow's also very important. Tomorrow we're going to get the report from Jameson Greer, from the Treasury Secretary. All of his advisors have put together a report looking at trade imbalances. They don't need to make it public. Will they make it public, or will it be leaked? And I think that'll give us a sense of what we can expect on April 2nd, Liberation Day.
The weekend was full of headlines. Let's unpack another one. This one right here. That President Trump was threatening to bomb Iran and start secondary tariffs if the country does not come to a deal over its nuclear program. Trump making the comments to NBC News over the weekend. More big headlines on the foreign policy front.
Again, this is a maximalist approach. This is how Trump likes to start deals. This is how he likes to start negotiations. What really caught my eye when it comes to Iran is that Iran had written a letter back to Trump. Trump written the Ayatollah a letter, and they said they will not engage with the Trump administration directly when it comes to potentially having a negotiation on nuclear. This says to me that Iran is willing to maybe engage, but not directly, because they would prove very weak domestically, because they'd be sitting down with Trump and his team, who went after Qasem Soleimani, who they said they want to avenge. But it meant that the door is still open for them to negotiate, but maybe with a third party, like the Emiratis or the Omanis.
Secondary tariffs, Iran. Secondary tariffs, Russia. Secondary tariffs, Venezuela. What do they all have in common? China.
They all have China in common, because where's all this oil going? Whether or not it's a little bit from Venezuela or a whole ton when it comes to Russia, and then a lot when it comes to Iran, basically keeping them somewhat afloat when it comes to those FX reserves. All of this oil is going to China. My question is, we don't have tariffs on these countries. We have sanctions on these countries. So would Trump then have to put tariffs on these countries' oil? I'm a little bit confused on actually how logistically this would play out. But I think the bottom line is he's willing to use economic state warcraft, like the Biden administration, to go after his foes.
Crude in Chicago this morning up by 0.5% on Brent, just north of 74. On WTI up by about 1/10, just short of 70, 69.45. Tesla down this morning by 6%. The CEO, Elon Musk, admitting Doge and his political activism is weighing on the stock at a town hall in Wisconsin.
It's costing me a lot to be in this job. What they're trying to do is put massive pressure on me and Tesla, I guess, to you know, I don't know, stop doing this. Well, you know, my Tesla stock and the stock of everyone who holds Tesla went roughly in half. I mean, it's a big deal.
It is a big deal. Musk also going on to hand out checks to political volunteers and compared the Federal Reserve to a magic 8-ball.
Yeah, and he himself has thrown $14 million to this Wisconsin State Supreme Court race. When it comes to the Fed, I was reminded what he did in November of last year. Remember, he put out a Twitter poll, which would do a better job deciding interest rates, the Federal Reserve or the magic 8-ball. The magic 8-ball won by 82.5%, according to this Musk poll. So I think he's tactically realizing the consequences of what it means to be the quote-unquote first buddy to the President of the United States when it comes to Tesla stock, but at the same time, he's still willing to put his opinion out there and be somewhat controversial.
The focus for them over the weekend was Wisconsin. Florida over the next 24, 48 hours will be fascinating. Consumer sentiment is cratered. I think struggling to see how this affects the midterms 18 months out, a year, 2 years out, is really, really difficult to do. But we get a flavor of things in a Republican home base over the next few days.
I think most important, what you want to look at is Mike Waltz's district. You had the Republican leading by a ton, bringing in a ton of political donations. It's gotten a lot tighter now, and that is of concern for the Republican Party right now. They think that he's going to win, the Republican candidate, but it's going to be tighter than they expected.
One to watch over the next few days. Let's turn to this. Investors gauging demand for AI with eyes on the data center space. Vikram Malhotra of Mizuho writing, quote, data center bookings are likely to continue at a strong, if not record pace, but there is an increasingly split view on whether pricing power is strong or waning. Second derivative. Vikram joins us now for more. Vikram, welcome to the program.
Thank you for having me.
Let's go through the headlines of the last week or so. So we had the DeepSeek revelations at the start of the year. In the last week, we've heard from the Alibaba chair, who speculated about a bubble and overcapacity in data centers. And then we heard a report from TD Cowen suggesting that Microsoft had pulled back on projects in both Europe and the United States. So a lot of people are stepping back, hands off, and saying, what on earth is going on here? What do your channel checks see? What are you seeing right now?
So at Mizuho, our channel checks suggest that there's near-term demand is likely to be record, both for co-location and hyperscale. In fact, there's chatter, there's a several hundred megawatts deal likely to hit over the next few, maybe this quarter, the next quarter. So I think near-term demand is very strong. The question is, how long will this continue? And then does it morph into more specific demand as we go into inference? But I think the key is going to be pricing power and what that means for cash flow going forward.
There, of course, was that note, though, that Microsoft was pulling back, potentially on data centers. What does that say to you?
You know, it's interesting. So some who may say, oh, this is a new phenomenon. We have not seen Microsoft pull back, or it's pulling back after 4 years of record demand. I think pulling back away from LOIs, as they're called, versus actually a lease is more common than you would think. And it's more resetting the growth rather than a sign that demand is not there. It's also supply chain issues. So, for example, if Microsoft said, hey, I want to open up a 50 megawatt data center, but now my chips are not coming for 12 months, then they will pivot and go back, as opposed to I don't have enough training to do. So I think it's more supply chain linked than actual demand linked.
There's a phrase you use, pricing power. Are there some games going on here?
It's a very fascinating question. So I cover real estate, and pricing power is key for REIT stocks. There could be game theory. It could be, hey, I'm Microsoft, let me say I'm pausing or slowing. Let's see what everyone else do prices come down? At the end of the day, in any real estate asset class, when you're at 2% vacancy, like you are in data centers, you definitely have record pricing power. And I think the question is, you have essentially Porter's five forces. You have 5 or 6 real buyers of the space or lessors of the space. You probably have 30 different landlords. And the question is, do they have any power over these hyperscalers?
And one of the buyers of that space, Alphabet, there's a line that came from the CEO a number of quarters ago, and I'm sure you remember that line. You're better to overinvest in this space than underinvest. Do you think that's still the case?
I think so. Near term, it makes sense because there's, what we were talking about earlier, it's sort of like, when we got the iPhone, the first iPhone, it was magical. And we're like, oh, this is a game changer. But it was until iPhone 9 or 10 or 11 that was truly a game changer. I wonder if we still need that app or that, let's say, foundational model that's truly game changing, requires a lot more compute. So near term, I think demand is strong. The question again is, does it sustain itself over the next 3 years?
Is there enough power to supply all of this?
In the US, we probably have enough power. We probably just don't have the right transmission or getting the power to the right places at this point. So certainly the question is, if demand picks up even further, we need alternatives, perhaps nuclear, perhaps something modular. There's a lot of debate around on-site generation versus linking into the utility itself. Near term, I think we're fine, but the question is, if demand continues at the record pace we saw, then we probably run into a problem.
Can I just jump in? Do you think that some of the buyers are getting more comfortable with off-grid power solutions than maybe they have been in the past?
I think so. I think there's a desire to be off-grid. There's also a need, just as I mentioned, but theoretically, some of the big buyers also want to be green. So they're also finding ways like solar, for example, wind, turbines. Can we do things that will make us more green as well? I think they are. They also want control over their facilities, so that's why they'd be more comfortable on campus, essentially.
That feels like they're going to basically need deregulation, transmission lines, all of that to happen from this administration. Do you see that being the direction of travel?
I think so. I think also we need another band of pricing, honestly. We don't know what data centers truly cost. We have commercial, residential, industrial, but we don't have something called data centers. So we probably need a band like that. But yes, I think it all comes down to a lot of these hyperscalers, what they view as critical, which leases, which properties, and then how much control they want. And I do think they're going to move to the direction you just talked about.
Vikram, wonderful to get an update from you. Lots to think about, particularly over the last few weeks. Vikram Malhotra there of Mizuho on the latest situation with data centers. If you are just joining us, welcome to the program. So we're down across the board here on the S&P. We're down by 1 percentage point. On the NASDAQ 100, down by more than that. Over in Europe, the equity benchmark in Frankfurt, Germany, the DAX was lower by something like 2% the last time I looked. In the bond market receives a bid. So we've got yields lower across the board. At the front end of the curve, we're down 7 to about 384. So we kick off Monday morning, very much risk averse, 2 days away from Liberation Day. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hacker. Say Yahara.
Hi, John. President Trump threatened secondary tariffs on buyers of Russian oil if President Putin refuses a ceasefire with Ukraine. Russia is one of the world's 3 largest oil producers, meaning any attempt to hit purchases of Russian supplies could have a far-reaching effect on the oil market, and any disruptions could add to inflationary pressures. And Apple is preparing its biggest healthcare push to date with the revamped health app and AI doctor service. The service would be powered by a new AI agent that would replicate, at least to some extent, a real doctor. The plan would see the health app collect user data, and then the AI coach will use that information to offer tailor-made recommendations. And gold continues to shine, starting the week with a fresh record high, topping $3,115 an ounce, beating its previous record set on Friday when it recorded a 4th weekly gain. Prices have been supported by growing safe haven demand amid a risk-off mood in markets, which we're seeing today. That's your Bloomberg Brief. John?
Yahara, thank you. Gold up by 1% on the session already. Up next on a program, reshaping global trade.
I think the first thing that I'm hearing is certainty, and just lay out the plan on how you want to use tariffs to open up more markets. It's best to tackle this Canadian and Mexican issue inside a new and revised USMCA.
We'll extend this conversation with Noor Christiani of JP Morgan Private Bank, live from New York City this morning. Good morning. You're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
New forecast from Goldman getting tons of attention. Year-end price target on the S&P now 57. A month ago that was 6,200. At the start of the year that was 6,500. Coming down. Equity futures coming down too. We're down by more than 1 full percentage point. The outlook for growth from Jan Hatzius and the team at Goldman, just 1% GDP for 25. Core PCE, 3.5%. That's a position this Federal Reserve probably doesn't want to be in.
Absolutely not. As you've been talking about all morning, Jonathan, this is the stagflationary fears that many are concerned about. And what does the Fed do with numbers like that? All of this also being driven by the fact that Goldman Sachs, for the second time this month, are increasing their tariff assumptions. Basically, they're saying tariffs are going to go up, this is going to be inflationary, and potentially this is going to cost on the growth side. You have to think, if you're the Federal Reserve, you might be a little bit worried you used the T word when you were speaking to the press.
The chairman used that T word in his news conference 2 weeks ago, transitory. they could look through all of this and maybe cut interest rates and focus on downside risk to growth. Mike Gapen of Morgan Stanley suggesting a few times in his research over the past few weeks that is easier said than done, and it is certainly easier said than done. In the bond market, yields are lower, though. We're down another 7 basis points at the front end of the curve, 384. On 10s, we're down about 6 to 419. Under surveillance this morning, reshaping global trade.
I think the first thing that I'm hearing is certainty, and just lay out the plan on how you want to use tariffs to open up more markets for Americans, have reciprocity on fairness in certain markets that are highly disproportionate. When it comes to North America, let's renegotiate USMCA. If you want to limit certain inputs from China into Canada, Mexico, or the United States, you can do that in the agreement. It's best to tackle this Canadian and Mexican issue inside a new and revised USMCA.
So here's the latest this morning. Canada and Mexico gearing up for 25% tariffs on non-USMCA goods on Wednesday, followed by 25% auto tariffs on Thursday. Noah Cristiani of JP Morgan writing, Mexico is the US main trading partner, and the industries of both countries are deeply intertwined. Any incremental tariff announcement could challenge this further. The situation is tense, but we believe pragmatism will prevail. Noah joins us now for more. Noah, good morning and welcome to the program.
Good morning. Thank you for having me.
That's a more constructive outlook. You spent some time in Mexico, I believe, recently. Give us the idea of how things are playing out there versus how they're playing out here.
Well, I have to say that the clients that we met with last week are certainly very concerned. Beyond the tariffs, in general, the economy was looking quite challenged this year, as it was. Tariffs definitely, or the risk of tariffs definitely do not make it any better. Especially in the northern part of the country, what we're seeing is that clients were, I would say, maybe over-prepared for the nearshoring boom that was coming. And not that it is not happening, but probably it's going to be more gradual than what they were penciling in. And what that means is there's a big amount of overcapacity that was built that right now they are having a more challenging time finding who to lease it to, or maybe renegotiating some contracts. So that, of course, is meaning that some of them are having to pull back on investments or at least pause. So that is leading most economists in the street to now talk about the possibility of a recession. The clients that we talk to on the ground are saying we're already in a recession in Mexico. So that's quite a challenging environment. And that, as I mentioned at the beginning, it's even without the tariffs actually being implemented.
Do you think all of this, when it comes to Trump and his rhetoric on USMCA in Mexico, is to bring those negotiations up for a trade deal that are supposed to start at the start of next year instead have them now?
Well, as we pointed out, as Jonathan mentioned, we believe that the two industries across both sides of the border, and of course we cannot let Canada out of the picture as well, let's say the two sides of the two borders, industries are really closely intertwined. So it's very hard to separate one from another. Of course, you know, all countries need each other, and we believe that at the end, pragmatism will prevail. Having said that, USMCA was bound to be revised June 2026. We believe that that's going to be brought forward. That revision is probably going to become a full renegotiation, the way somewhat what NAFTA then led into USMCA. So we cannot rule out that scenario. And one other thing that we need to consider is the possibility that maybe USMCA will end up breaking it in two bilateral agreements. The administration has been openly saying that they are much more open to the possibility of bilateral agreements instead of multilateral agreements. So that could also be an option. It could be somewhat disruptive, but not necessarily totally breaking havoc, precisely as long as the terms are maintained.
Trump has talked warmly about the Mexican president and saying that really he thinks is someone he can maybe do deals with. What do you think the biggest concession Mexico could make to really have a better trading relationship with the United States?
Well, I think that the most important thing that we've seen so far is that both administrations are very open to talks, are very open to negotiating. And I think that both sides recognize the importance of each of their partnerships. Having said that, I think that the Mexico administration has also been very consistent on making sure that they prioritize trade with the U.S., and we don't think that that's going to change in any way.
Does that mean shutting out China?
I think it's very hard for us to say that they're going to shut out China altogether. I think more so it's prioritizing commercial relationships that have a bigger presence or a bigger representation for the Mexican economy.
At the start of the year, we were expecting tariffs, but we thought they'd mean something else for foreign exchange. We thought it would lead to a stronger dollar. It's led to a weaker one. And if you look at dollar mex on a year so far, The Mexican peso is actually slightly stronger now on the year relative to the US dollar. So when you speak to clients, how are they managing foreign exchange risk at the moment?
That was one of the most, I would say, consistent questions that we got across the board, right? Why was the Mexican peso so strong? Our answer was it wasn't really that much about the Mexican peso. It was much more about the weakness that we were seeing in the dollar. And the way that we see that playing out is mostly against the euro, right? And given everything that has happened, the announcement of the German package, the upward revisions that we've seen, we've also increased our expectations for European growth, especially after everything that came out in the last couple of weeks. So with that weakness in the dollar has translated into strength in weakness that we're lagging. The Mexican peso is one of them, the Colombian peso is another one, the Brazilian real. So it's not just about the Mexican peso. Now, having said that, one important consideration that we have to make is the rate differential. Rates in Mexico are still somewhat high, even though the bias is for strong easing.
Do you think, given the overcapacity that you indicated at the start of the conversation, there is space for Mexico to reduce interest rates maybe more aggressively in the year ahead?
Yes, we do expect the central bank to cut back more aggressively. They cut last week by 50 basis points, and we expect continued cuts in a 50 basis point increment.
When it comes to that overcapacity, what do you expect these companies to do? Why they wait for potential renegotiation of USMCA, which could be 6 months to a year?
Well, this overcapacity is not necessarily totally idle. Some of them, what they're saying is, okay, we are closing into the next renegotiation. At first, I thought I had all the cards in my hand, and now maybe I'm going to have to wield some of that power to my counterparty. So we think that eventually there's going to be a new equilibrium.
Who's the winner? So in the winner of the first round of the trade war we saw in the first term, it was Mexico. Went after China. We had all this conversation about nearshoring, friendshoring. Mexico wins. Who wins now?
I think that everybody should win, right? There's a possibility that things turn south and go sour. We don't expect it to be that way. And at the end of the day, the conclusions that we had from most of our conversations with Mexico and with Mexico industrials were that at the end of the day, business people tend to find a way out. And we don't think that this time will be any different. So one interesting, and I'll make one very specific example. Back in the NAFTA renegotiation, when it turned into USMCA, the national content, the domestic content requirement moved up from 60% to 75% for key industries, okay? Everybody was freaking out in Mexico. Why? Because they didn't have the capacity to bring that all the way up to 75%. Where did that lead us at the end of the day? Capacity was actually installed in Mexico. There were new factories, new production facilities. There was more education, more R&D, and we don't think that this time could be any different. We don't know where this is going to lead into, whether it's going to be a new USMCA 2.0, whether it's going to be a new bilateral agreement. But at the end of the day, the fact that as long as the importance of the commercial relationship between the two partners is maintained, there's definitely space for increased productivity in both sides of the border.
This was a refreshing conversation, let's put it that way. A pragmatic approach from the Mexican side, potentially.
What I keep coming back to, though, when it comes to Mexico, if they want to prioritize the United States, does it mean putting up the walls that the U.S. would likely want to see when it comes to tariffs on China?
No Cristiani of JP Morgan Private Bank. No, thanks for coming in. Appreciate it. Thank you. Equity futures on the S&P right now down by more than 1 full percentage point. Up next, Darryl Cronk of Wells Fargo, John Murphy of Bank of America, Neil Dutta of Renmac, and Deborah Cunningham of Federated Hermes. From New York City this morning, good morning to you all. The third hour of Bloomberg Surveillance up next.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
It's that consumer element that has changed that's giving us more concern, especially with potentially more tariffs coming.
It's tough. I mean, especially if your market call is tied to anything trade or tariff related, which it almost has to be.
The tariffs are stagflationary.
It's not necessarily about tariffs or actual inflation. It's about inflation expectations.
Once the market understands that this is actually coming through, that uncertainty starts to go away. But that doesn't mean that volatility goes away.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Let's start with some scores. Equity futures off the lows, still down 1% on the S&P. On the Nasdaq 100, we look like this. On the Nasdaq 100, we're negative by 1.45. Big underperformance over in Europe. The DAX down 2%. The Nikkei overnight closing lower by 4 percentage points. What do bonds do? They do what they're meant to do. Bond yields are lower this morning on a 2-year, 10-year and 30-year. On twos at the front end of the curve, down by close to 7 basis points at 384. Further out along the curve on 10s, we're down 6 basis points to 419.19. Your week ahead, shaping up as follows. If you don't like weeks like this, you're in the wrong job.
That's for sure.
Jobless claims on Thursday, payrolls on Friday, Liberation Day on Wednesday, tariffs and the data in focus.
Tariffs and the data in focus. For me, obviously, it's going to be Wednesday, Liberation Day. I think policy has been the main focus for every investor. And what they're trying to grapple around is, what does Wednesday mean? Is it going to be this clearing event? Will the uncertainty finally mean we will have certainty in the form of what these tariffs may look like, what trading partners the American administration is trying to recalibrate with? I don't think so. Trump's coming in a very maximalist approach. What levers is he going to be using? How is he going to structure this legally? And is it the opening salvo for negotiations down the road?
I'll give you 3 takes, and they're all the same. Max Kettner, HSBC. Tariff noise likely to extend beyond the 2nd of April. Morgan Stanley's Dan Skelly. This week's tariff deadline will likely be more of a starting point for negotiations than a conclusion. Julian Emanuel of Evercore, who is bullish, says this: a peak, not an end. in uncertainty. This just goes on and on in the minds of many.
And the problem is, how damaging is that going to be when you see consumer sentiment, when you even see things like a CBS YouGov poll over the weekend that shows that people are concerned about going out and spending, and because of the tariffs that are emanating from Washington, D.C. And then you have to think this makes the Fed's picture for the future so much harder.
Upside risk to inflation, downside risk to growth. What does the Fed do? So far, they can sit here and say what they have been saying. Soft data bad, hard data okay. Soft data, survey data, consumer sentiment 2-year low. Long-term inflation expectations 32-year high in New Mitch on Friday. Anxiety about unemployment, 2/3 expecting unemployment to rise in the year ahead. The highest reading going back to when? Back to 2009. Are things that bad? Will it just stay in the soft data, or will it spill over to the hard data? That's why this week is so important. ADP, jobless claims, JOLTS, payrolls on Friday. We get some hard data.
Does it bleed into the labor market? I thought that was a fascinating line from you, Mitch, on Friday. Labor market expectations worsened considerably, not just among Democrats, across demographic and political groups. On top of that, we have been talking about for years, since the pandemic, it's the high-end consumer that's lifting all boats when it comes to the U.S. Well, expectations among high-income consumers, they also sank. It's across the board.
Equities down across the board this morning as well. We're down by 1% on the S&P. Coming up this hour, Darryl Cronk of Wells Fargo with 2 days until Liberation Day. John Murphy of Bank of America on how the auto sector is bracing for 25% levies. And Neil Dutter of Renmark on whether there's a light at the end of the tunnel. We begin this hour with stocks on course to wrap up their worst quarter since 2022. Darryl Cronk of Wells Fargo seeing tariffs having a measured impact, writing tariffs hurt the economy by complicating CapEx decisions about the future. But today, the issue is mainly price increases, which we foresee as incremental and dilute. Darryl joins us now for more. Darryl, good morning.
Good morning, John.
I have to say, there's a more constructive view from you.
Yes.
Where does that come from? What underpins that view?
Well, I think it's, obviously Wednesday will be big. We're looking at it through kind of 3 lenses. One is, what is the universe, right? So think tariffs on imports themselves. I'm really focused on things like the VAT as item 2, right? Then you've got non-tariff subsidies, things like, where you subsidize an industry. And then you can also have some noise around currency manipulators. Countries are labeled by Treasury as currency manipulator, or at least put on watch lists, right? That universe will break down between universal and sectoral. And then I think what we really want to focus on Wednesday is what's known versus unknown, right? So we know the autos, right, at 25%, imported autos and auto parts. We know we're probably going to see the additional tariffs on Venezuelan oil, right? And we know that there's going to be some impact on Mexico and Canada, the USMCA coming back, maybe 25%, maybe less. The key is, do we buy another kind of month of negotiation time, as the Treasury Secretary would say, escalate to de-escalate, right, and some room to negotiate? Or do we just, on April 2nd, let them have it, right, and kind of implement those tariffs?
Do you think that it's going to be reciprocity for each individual country or universal across the board?
I think it's country by country. I mean, I know there was a lot of banter about universal over the weekend.
And the entire campaign trail?
I understand. And I think that's part of that escalate to de-escalate. It's trying to send kind of the worst case message and scenario. But I think what the president and the administration is really interested in doing is negotiating country by country on very specific things. Like, what we still haven't seen is tariffs on pharmaceuticals. We haven't seen tariffs on semiconductors. We haven't seen it on copper, timber, lumber, right? A lot of those sectoral elements that people are talking about are still forthcoming. So whether we get some of that on Wednesday or not, I think is important. But I don't know that I'd look for just broad-based universal tariffs. I think it's a negotiation ploy country by country.
Do you think some countries, say they have a massive export of copper, they will face both?
Yes.
So they will be doubly tariffed, doubly taxed?
Yeah, I think if you break down, so very interested in closing trade deficits, right? If you look at the top 3 trade deficits, China runs about a $295 billion trade deficit, number 1. Mexico, number 2 at $175 billion. Vietnam, number 3 at $125 billion, right? And then you go down. Actually, Canada is number 8 on the list of actual goods trade deficit. If you close that, and only close that at the same tariff rates as what they charge us, it's about $50 billion worth of tariffs. If I add in the VAT, right, the value-added tax, now we're talking 3x that number. It's about $170 billion by our math. So the VAT matters, I think, in how they're going to play this out in the coming week.
This is a relative game, but who wins, who loses, relatively speaking. I think what's interesting about the call from you and the team at Wells Fargo at the moment is you're sticking with US economic leadership.
Yes.
That's a theme for you guys coming into the year, and you're staying with it as other people change their forecasts. What's interesting about this morning, if you're just tuning into the program, yes, you'll see equity futures down across the board. The S&P down 1%, but check out Japan, down 4%. Check out Germany, down 1.8%. Starting to see, and I know it's very early days, and we've seen some massive outperformance in those parts of the world over the year so far, but are things about to change?
Yeah, I think there's a lot of chasing that happened earlier this quarter, particularly. Let's pick on Europe, for example, and the German fiscal spend on defense and everything else. If you go back since 2007, so go back, literally, almost 20 years, 18 years, the time period of sustained European outperformance relative to the U.S., I threw a chart in my notes today, shows that it's on average about 90 to 180 days, and then it fades. Why does it fade? Because you need a sustained lower dollar for that trade to work over any long period of time, and you need earnings to deliver, right? If I went back again to that same time period and said, show me aggregate U.S. S&P earnings, 175%. Show me aggregate Euro earnings, 7%. That's the differential over that time, aggregate, right, of earnings growth. So if I don't get earnings growth and I don't get a weaker dollar over any period of time, that trade invariably fades on you.
So far, this trade story has led to a weaker dollar. Do you believe that reverses, and why?
We think it stabilizes here, right? So I would not look for the Dixie to go back to 110 across the broad baskets, but I do think you can have it go back to kind of the 106, 107 kind of range and just stabilize here. I wouldn't look for just continued weak dollar, right? And if we are, that kind of flies in the face of this growth scare, right? Because obviously, if you're going to get growth scare, what's going to happen? Flight to quality, U.S. Treasuries rally, dollar rallies, right? All that stuff. That just doesn't make a lot of sense to us.
This administration, do you think, wants a weak dollar because they want to see, a rejuvenation of exports?
I think they're quintessentially the same as a lot of administrations that say they want a strong dollar but actually want a weak dollar, right? Because the weak dollar favors economic growth to an extent, as long as it's not a debasement of the currency or something like that. It's just a sustained kind of steady weakness. I think you can live with it. I think what people miss here in the economic story in the near term of U.S. over some of the other parts of the world is you do have rates coming down. You do have the dollar that has come down, right? Labor markets are still okay. We're just about ready to roll into Q2 or Q1 earnings season, excuse me, right? Today's the end of the quarter.
Yep.
So we'll see what people say about earnings.
Do you think we have reset expectations for earnings low enough?
Not yet. I still think that has to come. And I think what happens is whether it's consumer spending, if you look at the drivers of what's been the growth drivers in the U.S. economy, it's AI CapEx, it's the high-end consumer spending broadly, but particularly the high-end consumer, and it's the fiscal impulse, right? So if I lose those engines, right, am I losing AI CapEx? Am I losing the high-end consumer? Am I losing some of the fiscal impulse, right? Something else has to step into that void at this point, right? Which means that growth is going to be anemic here for a while, and it's going to be hard to generate it.
Question marks over all three.
Yes.
Which one of those engines are you most concerned about right now? Because the one that I don't think gets talked enough about is the AI story. We're all obsessing over the trade headlines, but over the past few weeks, we've had some pretty damaging headlines for that part of the market, and it's an important part of the equity market.
Yeah, if you take the top 10 names, obviously in the S&P 500, they still account for 50% of the net income growth in the index. 50%, right? I mean, talk about the skew, right, and lack of breadth that we've talked about many times. So obviously the broadening out of that. What's not discussed, John, is, so we're going to probably put, at the end of today, one of the weakest quarters as a whole for technology as a sector in probably 30 to 40 years, right? Energy's up 7%, right? Financials and comm services on a relative basis are doing quite well, right, compared to the industry and everything else. It's really centered in tech and consumer discretionary, right? So I agree with you on the AI CapEx. I'll tell you what, though, I watch very, very closely that high-end consumer. Actually, high-end consumer spending and expectations now have dipped below the middle quintile tiers, right? So it's hooking down harder than even the low and middle quintiles. So That's where your discretionary spend comes from. And the question isn't, are they able to spend? They're still able to spend. It's just, are they willing to spend?
That's the big question going into earnings season. I've got some good news. Bonds are working.
Yes.
This has been the allocator's dilemma over the past few weeks. And we've said repeatedly on this program, on down days in the equity market, bonds haven't behaved in predictable ways. Sometimes yields are up, sometimes yields are down. They're down this morning by 6 basis points. Can you depend on that in the year ahead?
I don't think so, because I think what happens is eventually we get a little bit past this growth scare in the near term, and we really, the inflation narrative really starts to come back to the table. So when you look at the long side of the curve, it's really 3 premiums, right? It's a term premium, it's a growth premium, and it's an inflation premium, right? So if I hold term premium even, I bring growth premium down a little bit, all else equal, that's what's driving long side of the curve down. But I'm pushing up on inflation expectations and premiums in that long side. The question is, which one wins the day, right? Does the growth scare carry the day? And that's why you see the kind of dilemma that happens. If it's a particular day where a piece of economic data suggests the growth scare is a problem, right? You get a flight to quality, rates down, right? You get a bad inflation reading like we got, although it wasn't bad, but a little higher inflation reading last week, right? 2.8% on inflation. All of a sudden, rates move higher.
Darryl Cronk of Wells Fargo. So much to think about going into this week. Tons of data, lots of Fed speak still to discuss over the next several meetings, and then you're going to have Liberation Day on Wednesday going into earnings season over the next several weeks. So good luck to you all out there.
And Liberation Day actually going into earnings season might be an excuse for a lot of sweet executives to say this is why the consumer's not spending, because of the tariff policy coming out of Washington, D.C. Is that really what's happening underlying in the economy, or is that just easy access excuse for the moment?
We've seen that from some of the retailers, that's for sure. In the bond market right now, yields are lower by 6 basis points on 2s. We're down 6 on 10s. Your 10-year just below 420. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Iran's president says Iran won't engage in direct negotiations with President Trump. In televised remarks, the president said the decision was conveyed by Iran's supreme leader in response to a letter Trump sent earlier this month on the prospect of talks over the country's nuclear program. However, he did say indirect communication with the U.S. is still a possibility. Meanwhile, Elon Musk has acquired the social network formerly known as Twitter for the second time in 3 years. That's because Musk used his artificial intelligence startup xAI to purchase X in an all-stock deal that values the company at $33 billion. The new joint entity called xAI Holdings has a value of more than $100 billion. And Trump Media will become the first new stock to list on the New York Stock Exchange, Texas. The operator of Truth Social, Truth Plus, and Truth FI will trade under the ticker DJTWW. And NYSE President Lynn Martin saying the exchange announced last month will allow companies to capitalize on pro-business dynamics in Texas. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the Morning Calls Plus, John Murphy of Bank of America Securities on looming U.S. auto tariffs. That conversation just around the corner. Your opening bell, 1 hour, 15 minutes away. Your equity market down 1%. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The open in about 1 hour, 12 minutes away. 3-day losing streak through Friday. It's about to become day 4 unless this turns around. We're down by 1% on the S&P, negative by 1.6 on the Nasdaq 100. That's the price action. Let's get you some morning calls. BMO downgrading US Steel to market perform, pointing to uncertainty over a deal with Nippon Steel. Your second call from Wells Fargo, lowering its price target on an Alphabet to 167, seeing ongoing disruption in the search business. That's stock down by another 1 percentage point. And finally, Stifel cutting its price target on Tesla to 455, citing lower sales and headwinds from the, quote, anti-Elon Musk crowd. That stock is down again this morning. It's negative 6% in early trading. Let's stick with autos. The industry bracing for 25% tariffs on imports set to take effect on Thursday. President Donald Trump telling NBC News he, quote, couldn't care less if automakers raise prices in response. John Murphy of Bank of America writing vehicle prices could increase as much as $10,000 if automakers pass on the tariffs in full. John joins us now for more. John, it's good to see you, sir.
It's good to see you here.
I'm sure you're exhausted, so thanks for being with us.
Yes, I'm very exhausted. There's a lot going on.
And you're going to be exhausted this week too. So let's start with the tariffs. 25%. How much of a pass-through are you and the team expecting?
Well, I mean, it's really unclear. Like you kind of let in there $10,000 on imported autos assembled elsewhere outside of the U.S. would be subject to potentially as much as $10,000 if they decided to pass through the tariffs completely. If they decide to break even in the interim, right? They make a decision. Listen, we're going to keep making vehicles. We're going to try to maintain our market share. They may pass through about $4,500. Or if they do something, even more extreme, they might decide, listen, we're not going to be able to make money on these vehicles. We're not going to import any, and we've got risk of the 7.6 million vehicles that are imported to the United States potentially being at risk. So there's a lot of layers of how this could get passed through and the impact on sales.
The management teams, I imagine, aren't standing still. I'm sure that you've been in touch with many of them over the past week or so. Stellantis, Ford, GM, Tesla. Tesla, limited impact here. Of the other three, how are they preparing for Thursday? What do they do?
Well, I mean, I think we've got the answers for the moment for Thursday. We don't necessarily have the answers for Friday or the following week yet. So the volatility in sort of what's going to happen here, or the uncertainty, is pretty extreme. And I think when you look at this, you're making a product and plant decision about 3 to 4 years out, and then you're going to live with that for about 7 years out from that as the product is launched in the market and produced. So you have a 10+ year window of committing capital. So it's very difficult on a weekly, monthly, or even annual basis for them to make very significant shifts. So I think at the moment, they're going to look at increasing some employment here in the U.S., trying to ramp up the utilization of their plants here in the U.S. to offset this. But from a large degree, they're not actually doing anything just yet because they don't know the rules of the game and they're long-term capital allocators.
Who's best positioned going into Wednesday?
So I think if you look at Tesla, Lucid, Rivian, the startup EV names here in the U.S., they basically are largely unexposed except for some of the electronic components that they would import. Ford is actually in a pretty good position. They're only importing 20% of their volume or vehicle volume here in the U.S., and none of that is really the big ticket items like the Expedition, Navigator, F-150, or even Super Duties. But you go down the list, GM's about 50-50 imports domestic to the U.S. But then you have companies like Nissan, Mazda, Subaru, some of the other names that are reasonably exposed. And I think there's a lot of sort of mid to long term sort of game theory you have to play here of where the market will go. And I think most of these manufacturers are going to produce higher end, higher mixed vehicles to try to offset this incremental cost. And I think that's really important to recognize. The low-end consumer is not going to be served, so basic transportation is going to be less available to the American consumer, and if it's available, it's at a higher price. I think the real long-term thing to think here is this is the door opening to the Chinese at the entry level and potentially coming here and building plants, employing Americans, potentially bringing their entire supply chain here and entering at the low end. I think if you sort of run this forward a couple of years, that's the thing we really need to think about.
Are you basically talking about the Chinese companies doing what Japanese companies did 2-3 decades ago?
Correct. We saw the Japanese do it in the 70s and 80s. We saw the Koreans do it 80s and 90s. It takes 10 to 20 years once you're here in the U.S. market to actually really gain a foothold. But I think that's probably what we're staring down the barrel of if this holds.
So the price war already started. It's important to take a big step back here and think about what the last 2 years looked like. We were talking about a real price war in China. We were talking about automakers cutting prices because the demand wasn't there. So when the president comes out and says things like, I don't care if they raise prices, is the consumer price tolerance even there in this economy for them to raise prices?
Well, we're already drifting off of all-time highs in auto pricing over the last couple of years. So I think if we were to look at this and really spread everything that we know right now as best we can, we're talking about a 5 to 15% on average price increase in vehicles. The consumer is not really there for that, so that would have a very significant impact. We kind of roughly were assuming it's a 2.5 to 3 million unit hit to SAR just based on price pass-throughs, right? So that's a pretty big hit to the market that's about 16 million units right now.
I'd love to go back to more of what the president said over the weekend. To Jonathan's point, he's talking about I couldn't care if these automakers raise prices. He said that then they're going to start buying American cars. The #1 car being sold right now in America is a Toyota RAV4, but it's produced in America. So say, would Toyota get an exemption or a carve-out?
Well, I think that RAV4 wouldn't be tariff, save maybe the powertrain and electronic components that are in it that might be imported. We have to kind of dig through that, and everybody's still digging through this. So yes, it might be non-U.S. companies, but it would be U.S. workers that would benefit. And I think that's kind of the ultimate end game. I mean, our rough estimate is you could have 105,000 direct jobs if you brought all that 7.6 million units of production or demand/production back to the U.S., create another sort of almost a million. Another million indirect jobs. So there's a big focus on creating jobs, but there's greater and greater automation at the plant level. So will that actually be sort of a net job gain, or will it just be bringing that manufacturing back here to the U.S.?
You mentioned when it comes to the American producers, Ford's in maybe more decent shape than GM. The issue with GM is their foreign components are Canada and Mexico. Will there be a USMCA carve-out for these autos? Do we know yet?
So right now what we know is on parts that are imported from Canada and Mexico, as long as they're USMCA compliant, basically 75% of their content is North American, that the percentage of the components that are, of the subcomponents that are produced in the US wouldn't be tariffed. Going through that right now is sort of mind-numbing. Nobody actually has the exact answer on that at the at the supplier level, the folks that are actually doing this, and that's why we have a tape delay on the tariffs being put on USMCA compliant components.
This wasn't mind-numbing. This was really thoughtful. John Murphy of Bank of America on what the future of this car industry in this country could look like.
It's challenging when you're getting potentially different parts from different areas of the world, even if you're under USMCA and this trade deal that was renegotiated by the President of the United States, you still might be in the crosshairs when it comes down on Monday.
Equity futures on the S&P down by about 1% this Monday morning. We're down across the board. Bond yields lower on a 2-year, 10-year and 30-year. The opening bell 1 hour and 5 minutes away. Wednesday's Liberation Day this week is full of data. We'll get the view of Neil Dutta of Renmac in just a moment, and Deborah Cunningham of Federated Hermes from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
So here's the story. 3-day slide on the S&P, about to become day 4. On the S&P 500, negative by 1%. On the Nasdaq, we're down by 1.4. The final trading day of the month of March, the final month of the first quarter. And we are down and heading towards the biggest monthly decline since 2022, down 6% so far. That's the equity picture. Here's the good news in the bond market. Bond yields are actually lower. We're down 5 basis points to 386. On a 2-year, we're down 5 basis points. On a 10-year to 420. And on a 30-year, we're down 5 to about 457.93. Over in Europe, let's finish on the euro. And I'll tell you what the equity market's doing there. The euro's weaker, 108.12 on euro dollar, negative 0.1%. And the equity market in Europe is much lower. The DAX underperforming, down by 1.9%. In Japan overnight, the Nikkei 225 down by more than 4%. The underperformance on the equity side of things this morning and through today's session at least is abroad. It's international. It's in Europe. It's in Japan. This week is a massive week, not just because of Liberation Day on Wednesday, but because of the economic data, including payrolls on Friday. Mike McKee has more. Good morning, Mike.
Good morning, John. I thought I was going to be a downer, but following your report right there on the markets, it's just a little bit like maybe Miracle Max in The Princess Bride. The economy is not all dead. It's just going to be mostly dead because of import tariffs, perhaps. We get a lot of data this week, as you mentioned, but not much of it is going to have very much relevance by Friday, except for maybe the jobs report. We do get the JOLTS numbers and ISM manufacturing tomorrow. ADP employment on Wednesday. Thursday, the trade balance claims and ISM services. Friday, those payroll reports. But all of those generally give us an idea or an insight into what's coming up. But because of the tariffs on Wednesday, we aren't going to have any idea what's coming up until we know more about that. So it's going to be hard for anybody to get excited except for payrolls. And you can see there, we are expecting a downshift that probably would have happened anyway as fewer people entering the labor force and payrolls move down towards a sort of replacement level, but no change in unemployment, no change in average hourly earnings. It isn't clear at this early point whether people think this is because it's the natural progression or they're projecting a slowdown, but it doesn't tell us a whole lot about where we're going, and that's going to be the problem going forward.
Mike McKee, thank you, sir, with an update on what you can expect. Just to remind you all that on Friday you will hear from the chairman of the Federal Reserve, Chairman Powell. He gets the benefit of waiting to see what we get on Wednesday and waiting to see what Friday morning looks like when we get payrolls, and then some speech editor can get hold of the thing and rewrite it maybe.
Well, I will say Wednesday, if Trump comes in maximalist approach, and then you basically see this opening salve for negotiations, and uncertainty may be pervasive when it comes to tariffs, and it might take weeks or months, is he going to think, I probably shouldn't have used the word transitory when it comes to inflationary impulse when it comes to tariffs?
We'll get into that in just a moment. Here's the take from Neil Dutter of Renmac. Looking ahead to so-called Liberation Day, writing, the overall strength in corporate earnings suggests companies may have the capacity to absorb some impact of tariffs without significantly impacting their bottom line. Neil joins us now for more. Neil, good morning.
Good morning.
Let's talk about how the economy's set up, how corporate America's set up, how resilient this economy is going into this announcement.
Well, profit, I mean, if there's going to be one party that has more ability to absorb the cost of tariffs, it's corporations, because margins are very, very high. Now, margins are high not only because of the tech industry, but even when you look at manufacturing companies, at least in the NIPA data, which is what I look at, margins are high for manufacturing companies. So what we know about tariffs is tariffs increase costs. How much they increase consumer prices remains to be seen. But what we know about the consumer is that their budget constraint is getting weaker, right? I mean, if you look at what happened last Friday, private sector wages and salaries, John, are up barely 3% over the last year. And whenever you have a situation where compensation growth is running below the rate of the overnight Fed funds, that is a sure sign that monetary policy is too tight. So we've been saying for a while that passive tightening was the dominant risk for markets. And this wait-and-see approach by the Fed, as the kind of administration figures out what they want to do, is just going to, continue to create this sort of negative feedback loop. Right?
If we do see prices pick up, it was implied in the forecast from the Federal Reserve and the SEP that it would be temporary. Chairman Powell reinforced that in the news conference. There's been some debate in the Fed speak since then, but there's one data point you've repeatedly singled out, and we see it in consumer surveys: anxiety around unemployment. Why is that so important when you consider what this might mean for second-round effects?
Well, if the unemployment rate is going up, wages are going, it goes back to, I mean, to me, inflation ultimately boils down to the household's budget constraint. And if consumers are not seeing their incomes grow, and you put tariffs on something, so the price of a car will go up, they'll have less left over to spend elsewhere, and they'll have to cut back on the purchases of those goods and services, which will ultimately drive down the prices for those goods and services. So, ultimately it comes down to where's the nominal economy. And the nominal economy, the Fed isn't changing the nominal anchor. Government's not going on spending more money. To me, that to me is, I guess, why I'm a little bit more sanguine on the inflationary consequences, but I think the growth consequences are more dominant as something to worry about.
How difficult, though, would it be for the Fed to cut into an environment when consumers are saying we have such high expectations for inflation?
They have such low expectations for their income, right? I mean, everyone's talking about inflation expectations in the University of Michigan data, and admittedly, I mean, Powell is kind of, sometimes he uses that data series to not do anything. Other times he uses it to go 75 basis point hikes, right? So, I understand why people focus on it. But if you look at that survey, look at what people are saying about their income, right? So how will inflation expectations work? I mean, you would expect to see people pulling forward spending to beat the higher prices. Are they doing that? No. Are they going to go ask their employer for a raise right now? No. I mean, people talk about DOGE not having an impact. One way it has had probably an impact is that it's created an overall sense of caution, right? I mean, if you see a lot of people getting fired, you might be a little bit more reluctant to quit. And that just tips the scales in the labor market dynamic towards the businesses away from labor.
2/3 expecting unemployment to rise in the year ahead in the UMich survey. Speaking to your point, so the soft data has been soft. This week's a big week for hard data. Would you expect to see any spillover whatsoever, or is it still too soon?
I mean, the sausage making of the high-frequency data is it's tough to forecast these data points. I mean, you can easily make an argument that maybe the jobs number on Friday surprises to the upside because weather was a factor weighing the numbers down in January and February, and, if that normalizes in March, then maybe you have like a big report relative to upside surprise relative to the underlying trend. That's why I say it's like, this sort of overt data dependence is not the best thing. I mean, think about the overall fundamentals. What we know is that income growth is slowing, and labor markets continue to cool. So the likelihood is that until the Fed pivots, that'll keep continuing. Everything that's happened so far in the Trump administration probably makes, with the uncertainty and all this, that makes a bad situation worse.
You'd be the first one to say there's a big difference between what I think the Fed should do and what they will do. What I'm hearing from you is that you think they should be thinking about reducing interest rates pretty soon. I'm also hearing that you also think they won't. Do you think they're going to hold on too long?
I think they already have. I mean, I think the pivot in December was a mistake. I mean, they've kind of invited this sort of game of chicken with the administration. I mean, they said that they wouldn't prejudge policies, then they did. And, now in their defense, I mean, Trump has given them every reason for that pivot with the tariff policy. But I do think that as they kind of wait and see, this wait and see, let's see what happens, and kind of not focus as much on the incoming data. To me, that's a mistake.
Well, you say we should take Trump literally. Do you think the Fed is?
I mean, let's see. I do think we should take Trump literally because we've had this now with the tariffs. Every iteration of what Bessent said at his nomination, we got the fentanyl use for it. Now we're seeing the reciprocal use for it. Like, oh, like this is a way to level the playing field. We're going to put tariffs on to actually escalate to de-escalate so we get a fair trading. And now, journal article this today talking about, well, we're thinking about a 20% tariff, which means they're using it as a pay-for scheme for other parts of their agenda, right? Because a 20% universal tariff raises a little over $3 trillion over 10 years, which would help the math for what they're trying to do.
If they go to 20% universal tariff, that's a very maximalist approach. Do you think that's the start or the end?
I have no idea.
I know they read your research.
What are you telling them to do, Neil?
Huh?
What are you telling them to do?
What would your advice be? Yeah.
My advice to them is to tell them, I mean, look, I think they should have been talking the economy down more on their way in. And the fact that they didn't has kind of opened themselves up to some problems.
This is important. Can I jump in?
Yeah.
You said this early on this year. You think there was problems already in this economy that predates the tariff announcements, correct?
Correct. Yes, absolutely. I mean, total hours worked contracted in the 3 months ending in February. Like, how are you going to pin that on uncertainty? And, you know, I do think the uncertainty thing is a little bit oversold. We'd be facing uncertainty if the shoe was on the other foot, right? We'd be having a massive tax cliff at the end of the year. So we've traded a lot of uncertainty in the short run for maybe uncertainty that we may not get later. You know, to me, I think the big issue is the Fed. And, you know, don't be surprised if a certain someone starts saying, feel the market in the next couple of months.
He's said that a few times already, hasn't he, over the past few weeks?
You know, I mean, look, I do think that one of the sort of overriding issues here is that, you know, for years, Republicans talked about austerity during the Obama years. Along comes Donald Trump. What are the first words out of his mouth? We need to prime the pump. And in many respects, last year, some of his advisors were saying the Fed goofed by going 50. They shouldn't have been cutting. This was a really strong economy. And along comes Donald Trump and says, I think we ought to be cutting interest rates. So a lot of the people around him are not ideologically aligned with him in some important ways. And I think he is his #1 advisor. As I say, don't be surprised if he starts taking to Truth Social or Twitter or whatever else and saying, feel the market and cut interest rates. And I think, you know, if you look at the way the markets are going, he has a point.
Neil, stay there. We'll give you the final word in just a moment. Neil Dunter there of Ranmac. I want to bring in Deborah Cunningham of Federated Hermes into the conversation. Deborah, welcome to the program. We have to start with the big question. I know it's totally unknown, but just a base case for you and the team. What are you expecting on April 2nd?
Well, our outlook at this point continues to be for a growth slowdown, not necessarily a recession. We think April 2nd will have ramifications that are unknown yet at this point. And ultimately, I think in the short run will be inflationary, which is why our expectation from a Fed perspective is to be pushed off into anything to be pushed off into the second half. But the short run inflationary expectations necessarily don't hold true for the longer run. If in fact we can get some productivity enhancement, if in fact we can, you know, have more hiring done within the U.S., then the potential for April 2nd could be that long run inflation is less than what the short run aspect of that will be. So. All of that points to higher rates for a little bit longer for now, and probably a terminal rate that's a little bit higher, but not necessarily anything that's, you know, a recessionary type of impact at this point.
But you still believe by the time we get to the end of the year, the Federal Reserve would be in a position to respond to downside risk to growth if they materialize?
Absolutely. They seem to be poised to do that now. I think maybe, you know, the previous speaker, Neil, was talking about the 50 basis point move in September. I feel like maybe that would have, the end of the year would have turned out a little bit differently had they not started the process with that 50 basis point move. But as we are right now, I think we're on hold for a period of time, but with the Federal Reserve quite poised to go lower in anticipation or in response to some sort of a further slowdown, and especially one that might be a little bit more than expected at this point.
Deborah, what if we don't get the end game when it comes to tariffs and there's uncertainty and negotiations for months? Then when can this Fed start cutting?
Well, I think the Fed is on hold for a period of time until there's a little bit more clarity, because it certainly seems like every time, something is expected on a date or on a day of the week, is within, hours, days, or weeks, it's negotiated away into something that's maybe less or different. And so I feel like for that reason, the market has had a lot of volatility associated with it. Short-term markets, long-term markets, equity markets, all being up and down with pretty broad trajectory. And in our estimation, where there's volatility, there's opportunity. So for our own short-term rate products, I mean, ultimately, if we can undertake longer-term securities, purchase longer-term securities into those portfolios at a point in time when they're 30 basis points wider than they might have been the week before, just simply because of the volatility that's present in the marketplace with the various changes in, expectation given what is the current scenario, which may be different than yesterday's scenario and different from tomorrow's scenario, then you end up with some opportunity. So that's what we're looking for in this market, is opportunity at the right time.
Might find a few of them in the next few days. Deborah, appreciate your time as always. Deborah Cunningham there at Federated Hermes on a week ahead. Neil Dutta of Renmax still with us around the table. Neil, I wanted to finish on this from Jan Hansis and the team over at Goldman. New forecast, PCE 3.5%, GDP cut to just 1%. They still believe the Fed could cut 3 times. What do you make of that mix of things for 2025?
I mean, I think they're largely just following them. I mean, price has an interesting way of leading the narrative, right? And so if you look at a chart of corporate credit spreads and just try to determine what that implies for recession probabilities in the next 12 months, 35, 40% makes sense, right? Like, so I think that's what they're largely doing. And 1% real growth. Yeah, I mean, look, if real incomes are barely growing 1%, we saw last Friday, real incomes net of transfers over the last 3 months is up just 1%. So if you assume a stable savings rate, that's more or less your consumption forecast. So if you have 1% consumer spending growth and you have things like state and local governments contracting, residential investment contracting, like where's the growth coming from? So you can easily come up with a scenario where growth is barely 1%. And if you're only growing 1%, that's putting upward pressure on the unemployment rate because you're growing below potential.
They also increased their tariff assumptions for a second time in less than a month. And that seems to be driving a lot of these downgrades in the S&P 500, upgrade and potential recession fears. Do you think any of it is warranted? Because I know you think the underlying economy is weak even before the tariff policies.
Yeah, I mean, I understand why people are adjusting those estimates. If, let's say, Wednesday comes around and it's not as bad as fear, maybe you get a relief rally, and then we'll go back to. I mean, remember, John remember this too. People were lighting their hair on fire over Brexit, and then a week later we were back. Basically, the FTSE was back to making new highs. So you have to be sort of careful. But I do think if there's a period of calm with respect to tariff policy, because it's not an on-off switch; it's a dial with Trump. That might mean that people start focusing back on the economic data, which would still be quite sluggish. So you could see a relief rally, and then maybe it goes back down.
Expectations for Friday? Payrolls? What are you looking for? Really?
I haven't.
That difficult?
I mean, I don't know. I mean, I think focus on the unemployment rate, focus on the household survey. I mean, that's going to be less affected by, weather stuff. And if things like prime age employment rates are going down, which they have been, then you should be dialing up your concern.
Neil Dutta of Renmax. Neil, good to see you in person. Thanks for dropping by the studio.
Thank
Neil
you.
Dutta there, in a shirt and tie as well, in a suit. Thanks for making that happen as well. We appreciate that. That's a payroll survey, a sneak peek of our side of things, putting all these estimates together. The median so far, and it can change, of course, as we get more updates and more estimates. 138 is the median at the moment, and the most bullish forecast on the street, and again, this can change. At the moment, it's Bank of America at 85. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Uber and OpenTable have announced a new strategic partnership. The first of its kind collaboration will integrate the company's apps to offer dining reservation access and transportation options. The partnership is expected to roll out in phases throughout the year. Meanwhile, in March Madness, the men's Final Four is set, and for the first time in 17 years, all 4 teams are #1 seeds. Florida returns to the stage for the first time in 11 years. They take on Auburn. Houston will face Duke. Houston is looking for its first ever title as Duke aims to end a 10-year drought. And in the women's tournament, top overall seed UCLA reached its first Final Four with a 72-65 victory over LSU. UCLA will face the winner of tonight's game between South Carolina and UConn. The Final Four is Friday night in Tampa, Florida. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Don't know what happened to the golf news, so here it is. Congratulations, Minwoo Lee. First win on the PGA Tour. Just phenomenal to watch him win over the weekend. Great to see Gary Woodland up there on the leaderboard as well, and the former Scotty and Rory going into the Masters in a week or so. Don't have to talk to me about it. It's okay.
You don't care about golf when the Yankees are just crushing.
We've done the Yankees already, and that torpedo bat, or wherever it is. Up next on the program, setting you up for the day ahead, you're watching Bloomberg Surveillance.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening bell around 38, 37 minutes away. Equities down by 0.9% on the S&P on a three-day slide. This is day 4 potentially. Can change. We're down by 1.2% on the Nasdaq going into the cash open. Your week ahead looks like this. Lots of economic data tomorrow morning. JOLTS plus PMI and ISM manufacturing data. Wednesday, President Trump's Liberation Day plus ADP and durable goods. Thursday, another round of claims and ISM services. On Friday, payrolls data and an address from Fed Chair Jay Powell. Let's head down to Washington, D.C. and catch up with Laura Davison in the nation's capital. Laura, welcome back to the program. Just a final word. What does the schedule look like for the next 24 hours?
So Trump will sign 2 different batches of executive orders today. In this latter batch, around 5:30 in the evening, he will invite reporters into the Oval Office, where he's sure to get a barrage of questions about tariffs and also potentially tax cuts. Scott Bessent and senior House and Senate leadership are scheduled to meet tomorrow about how to advance this bill. Senate leaders are looking at potentially a vote on sort of a preliminary tax cut bill as soon as this week.
Bloomberg's Laura Davison, thank you. Laura, thank you very much. Laura down in Washington, D.C. On the week ahead, coming up tomorrow, Jonathan Stubbs of Berenberg, Ed Yardeni of Yardeni Research, Emily Rowland of John Hancock, and Tiffany Wilding of PIMCO. A stacked lineup for you going into what is an important week.
Liberation Day, Jonathan, Wednesday. I'm getting already lots of messages this morning from people down in Washington, D.C. trying to game out what Wednesday is going to be in terms of, will this just be an opening salvo for trade? Will there be tariffs day 1 using IEEPA or 338? Or potentially, is it going to be a slow rollout, meaning there has to be investigations when it comes to trading partners? And potentially, if they're going to go that route, it means they're concerned about the legality of all this. So this may take a lot longer. So this clearing event that the market's hoping for may not be happening this week.
Based on your reporting, all of the above potentially, right?
Exactly, yes. And I also think that you have to look at what some of his advisors have said over the weekend, whether it was Peter Navarro or Kevin Hassett. Kevin Hassett, I can't give you any forward guidance on what's going to happen this week. The president got a heck of a lot of analysis before him, and he's going to make the right choice, I'm sure. That says to me that there is still some discussion about what they might announce on Wednesday. Key tomorrow, this report that the president asked for, an executive order after Inauguration Day, is going to be presented to him. This is from USTR's Jamison Greer, and they're going to be looking at the trade imbalances of all these partners. After he reads through that and gets a briefing on that, then I think they'll make some final decisions. Do we get to see that report is a key question people are asking themselves this morning.
That right there is your week ahead. Lots of trade. Concludes with Liberation Day on Wednesday. Lots of economic data. Look out for the ISMs. Look out for jobless claims. Look out for payrolls on Friday. And then that man right there, Chairman Powell, gets to talk about it all going into the weekend. Going into the opening bow this morning, equity futures on the S&P negative by 0.9%. We are down